You are welcome to my channel. This is Kevin Davis Accounting. Today, I would like us to talk about the income statement, the format of the income statement. Remember the previous video I told you that we are looking at the final accounts of a sole trader. And so we are starting with the income statement. I said that the income statement was previously called the trading profit and loss account. So as the accounting is evolving, we call it now the income statement. So the income statement is a combination of two accounts in one statement. We have the trading account and we also have the profit and loss account. So all of those two accounts are put into one statement and they are called the income statement. So this is how our format looks like. We shall have our particulars here. We shall have our amount. Usually it is any currency they give you in the question, but for now let me take the Ugandan shillings currency. Uganda shillings. Then also here, amount in Uganda shillings. And also here we shall have our amount in Uganda shillings. Sorry. Now, the added question would be, why are we putting three amount columns? Now, the reason is simple. It's because this last column is where we shall be taking the final figure. Now, there are certain transactions that we will have or will need us to have certain adjustments before we take it to the final column. So, those adjustments, for example, we might be required to establish maybe an amount of a certain item, and that item has other adjustments added to it. Therefore, we shall need to make an addition or an adjustment on that item before we take the final figure. Yes, so as you're going to see here, then this figure, this column also, there are certain items now, because before we post here, remember from here we take the final figure here. Now there are certain items also that also need other adjustments before they take it the second column. Then from the second column we take the final column. Now this is how our format looks like. We shall begin with sales. Our sales. So we record them here. Then after our sales, remember I told you we are looking for the net sales. We shall take off the sales returns. Sometimes they are called the returns inwards. So we bring them here. I'm using XX to represent money. So this is the representation of money. Now, when we take off our sales returns from our sales, what we shall get will be our net sales. So we are here. Remember I told you I told it will be net sales minus cost of sales, giving us a gross profit. And this is the trading account. So, and then from this, we shall have a gross profit plus other incomes minus expenses, giving us a net profit. So, this is how we are going to be going. So now, right now, we have so far established the net sales. So, we are supposed to take off cost of sales because we are looking at establishing the gross profit. So we are going to take off our cost of sales. Now, remember all these items when they're giving you a question, they're always given to you in the trial balance. So you're supposed to extract all these things from the trial balance. Now, in the trial balance, they're not going to give you cost of sales as an aggregate figure. No, you are supposed to find it on your own. So there are certain items that fall under cost of sales, like I told you in my introduction. So when you come here, you will say less cost of sales. Then you start listing them down. One, we shall have opening stock. Now opening stock, we shall come and record it here because it has no adjustments. So we shall record it here. This is our opening stock. Then we have add purchases. Remember, we could have bought some more purchases. So we add purchases. Now, for the purchases, they have adjustments. So Now, when it comes here, that means we are going to record it in the first column. Therefore, we shall bring it here. Then, we have purchase returns. Sorry, we shall say less purchase returns. So purchase returns are always subtracted. Now, there is something we call carriage inwards. Carriage inwards, these are transportation costs. For example, when you are transporting the goods that you have bought to your store or from wherever you have bought it from and you're taking it to the store, that means you will incur certain amounts of costs. That means you will incur that cost. Now that cost is counted part of the purchases. So we shall add it to the purchases. Like I told you that something, you might find something is 5,000 in town, but when you go to the village, that same item is 7,000. Now, the 2,000 I've added on that item is to cater for the transportation costs. So now, here, when it comes here, we shall actually add carriage inwards. So when we add it there, we shall get our net purchases. When I do this, I bring them on the same line here. Now, these are our net purchases. So, when I add up my opening stock plus my net purchases, I get what they call cost of goods available for sale. Meaning, when I bought, remember, I told you that you are coming from the previous year into this new year. Now, the stock that you have as a closing balance in the previous year, it becomes your opening balance in this new year. So, when it becomes your opening stock, it means you're going, for example, here, it's part of your stock also. So, my opening stock is part of my my purchases, my cost of goods available. Now, it means when I buy more purchases, I'm increasing the goods in my store. The goods in my store, I have the stock which I started the year with, or which I opened up the year with, and also I have more other stock which I've purchased. Now, when I get the cost of goods available for sale, I'll get the total goods that are in my store, the opening stock or the closing stock that remained, and the purchases that I've bought. Remember, all this becomes one in store. So when it becomes one in store, that means those are the goods that are available for sale. If I want to sell, those are the goods in my store that I can sell. I can trade against. So that's why we add it here actually, and we get the cost of goods available for sale. Now, if you want to establish the cost of goods, the cost of sales, the ones that you have sold, because remember we are looking at, these are the net sales here, but we need to know how much actually did these sales cost us. So if you want to know, now from this cost of goods here available for sale, we need to know how much remained in store. You see, so when we take off the one that remained in store, we shall get actually how much that was taken out of store. So we shall say less closing store. So closing stock, we bring it here, we less it. Now, in accounting, we don't do negative. What we do, we indicate in brackets to show that we are subtracting. Now, we shall subtract our closing stock. Now, why do we subtract our closing stock? Because this is the stock that remained. So, when you have the stock that you have had, and you take off the stock that remained, actually you get the stock that was actually sold. You see, so it's very easy like that. So after this, we shall establish our cost of sales here. Now, if these are our cost of sales that we have got, now it means from here we have our net sales, we are going to the cost of sales. So these are the cost of sales that we have. When we subtract the net sales, this from the cost of sales, then we shall have our gross profit. It could be a gross profit or loss. So we indicate it there. If it is a loss, you put in the brackets. So that's where we are now. So we are done with this and this. So ladies and gentlemen, this is what they call a trading account. This alone is what they call a trading account. Now, from the trading account, we are continuing now Remember, it's one statement, but with two accounts. So we are continuing. Now, we are here. So we are supposed to continue and add other incomes. Now, we are starting on our profit and loss account. So when we come here, we say add other incomes. All these things will be given to you in the trial balance. So you just extract it from the trial balance and bring and post it here. Now, other incomes, we can have things like discount received. You come in the second column, you put it here. We can have things like investment income. You come and put it here. Then we take the total, we add it here we add it to our gross profit. So when you add it to our gross profit, actually we shall get our total incomes. Our total incomes will be this. So this is what we have now. So after doing this, we are going to subtract, we are going to take off our expenses, our operating expenses. So we say less operating expenses. And these are already so many. We can have rent. We bring the second column. We place it there. We can have discount allowed. We bring it here. We can have depreciation. We put it here. We can have salaries and wages. We put it here, and so on and so forth. So we take our total of all expenses and you're going to subtract it since we are subtracting it here. So when we subtract this, actually we shall get the net profit. Ladies and gentlemen, this is how our income statement looks like. So at the end of the day, we are required to find the net profit. So it means that when we are calculating this, we are supposed to come up with a net profit. So this is the procedure. All these items will be given to you in the trial balance. So it's just a matter of extracting these from the trial balance and know where to place which one, because they will just give them to you. They won't differentiate for you. So you must have the format in your mind, at the back of your mind, so that when you know, for example, the cost of sales, you just know which items fall under the cost of sales. When we come to the incomes, which items fall under the incomes and the expenses as well. And then at the end of that day, we shall have our net profit. Now, listen, this net profit that we have found, this one, it will go to the statement of financial position, which we call the balance sheet. So it means if you get the profit or the net profit wrong here, even the balance sheet will not balance. The statement of financial position will not balance. So it means every entry here should be right, because if it's not right, then our statement of financial position will not balance. Remember, this is a net profit. So if it's a net profit, in our accounting equation, it's under equity, owner's equity, because it increases the owner's equity. Ladies and gentlemen, this is all about the income statement, the format. We shall solve a number on this at once, actually, with the statement of financial position. Otherwise, thank you so much for watching. This is Kevin Davis Accounting. Subscribe, recommend to your friends, share, like. It's a goodbye for now. Until we meet again.